Well, hello, everyone, and thank you for joining us today. I'm John Millay, the firm's Chief Operating Officer, Chief Financial Officer, and a wealth advisor. I'm really glad that you're here for today's webinar, which is our annual year-end tax planning webinar. This is always one of our most popular webinars of the year, and honestly, it's partially due to the important content and also due to our very knowledgeable presenters. As many of you know, tax planning isn't something we mention only at year end. It's a central part of who we are as a firm. We view our deep focus on tax strategy as one of our key strengths. Our team works year round to understand the tax code, explore creative opportunities, and ensure our clients stay ahead of changes rather than react to them. Today, you're going to hear from two of the biggest drivers of that tax focus. Both of today's presenters are wealth advisors and key members of our tax team. First, we have Vincenzo Testa. Vinny is a certified public accountant, a certified financial planner, and also holds an advanced equity compensation ECA designation. Alongside Vinny today is Scott Strohecker. Scott has the advanced EAIRS designation as an enrolled agent and also is a certified financial planner. Vinny and Scott are going to cover a handful of important topics, including what's happening with the One Big Beautiful Bill Act. You may recall Vinny and Scott did a webinar back in August, which is posted on our website. So you certainly check that out for really a webinar that's dedicated all about the OBBBA. They're also going to discuss some thoughtful gifting strategies, how to maximize retirement contributions, some distribution planning topics, and some powerful tax deferral strategies. We want today's session to be practical and helpful. We want to thank you again for being here today. We truly appreciate your time and the trust that you place in our firm. With that said, Vinny, let's jump right into it.
Thank you, John. So quickly, I just wanted to touch on some of the major tax updates that occurred this year. So on July 4th, there was some legislation signed into play, and it was called the One Big Beautiful Bill Act. And there were some major tax overhaul and changes to specific provisions. And there were a lot of changes, but the topics I'm going to cover, I think, apply to most of our clients, and I think they're relevant. So to start, I'll talk about the SALT cap. So this is state and local taxes. It's a deduction on your itemized deductions on your tax return, otherwise known as Schedule A. And back in 2017, when the Tax Cuts and Jobs Act was put into place, there was a cap put on how much in state and local tax you could deduct. They capped it at $10,000. That affected a lot of taxpayers, middle class and lower class and higher classes, especially New Yorkers, right? The SALT cap includes real estate taxes, income taxes, and in a state like New York, those taxes could be relatively high. So putting on a cap of $10,000 resulted in an increased tax bill, even though the tax rates decreased back in 2017. This really affected a lot of folks, like I said, especially New York, Connecticut, those high taxed blue states. So with the SALT cap being increased to $40,000 in the One Big Beautiful Bill Act, taxpayers that have high real estate taxes or state income taxes can expect to receive a tax saving. So this will be really beneficial if you're an individual who has high real estate taxes or high income taxes. So you'll see a tax savings from this in particular. There is an income phase out, and something to remember is that this increase is temporary, right? It could get prolonged if they pass legislation down the line, but currently it's in effect from 2025 to 2029. And to keep in mind, the income phase out starts at $500,000 for those married filing joint and $250,000 for married filing separate or single filers. So a phase out is when your income is high enough for the deduction to be reduced. So you could see at the table below in 2025, you could see as the income increases and the cap increases as well. And then in 2030, you could see it goes back down to $10,000. But like I said, they could pass legislation down the road to prolong the increased cap, but as of right now, this is where the tax law stands. Next is the senior deduction. I know over the past couple months or so, before the One Big Beautiful Bill Act was signed in, there was talks of no tax on Social Security, and this is really what the bill is aiming to do, is to reduce taxes on Social Security. So for those folks that are age 65 and older, you receive an additional deduction of $6,000. And if you're married, you receive $12,000 if both spouses are over the age of 65. There is an income phase out for this as well. So also keep that in mind, but it's just an additional deduction to help reduce the taxes that seniors are paying on Social Security. And personally I think it's great. Putting more pockets or putting more money into the pockets of consumers going to boost the economy. I think it's really a great deduction to include for older folks. The auto loan interest deduction. This is something brand new. So the One Big Beautiful Bill Act is allowing taxpayers to deduct up to $10,000 in loan interest on new automobiles. So the requirement is the automobiles have to be manufactured in the United States, right? So this is kind of incentivizing companies to manufacture in the United States because that'll increase demand for those vehicles that are manufactured in the United States. Another effort to bring jobs back in the US, also while helping the middle class or lower class taxpayer save some money on their taxes. So the eligibility window applies to all loans originated after December 31st, 2024. And this is also temporary from tax years 2025 through 2028. Eligible vehicles must be cars, SUVs, pickups, vans, or motorcycles under 14,000 pounds. And like I said before, the final assembly has to occur in the United States. So if you are looking to buy a new vehicle, it may be worth looking into vehicles where the final assembly was in the United States and you're under that 14,000 pound threshold, because it could save you some money on taxes. Just to put it into perspective, interest rates are a little bit higher than they have been in years past. So you could hit that $10,000 loan interest cap relatively easily, depending on the purchase price of the vehicle. So definitely something to look into. If you think about it in terms of numbers, if you're in the 24% tax bracket, which a lot of folks are, and 6% for New York State, that could potentially be a savings of $3,000 annually in taxes saved. So when it comes to looking to purchase a new vehicle, this is definitely something to look further into, because there is some serious money that could be saved if you execute this deduction. Next is the charitable deduction for non-itemizers. So back during COVID, this was a similar deduction that was enacted. Folks that were single were allowed to take a deduction of $300, and married folks were allowed to take a deduction of $600. They have now increased that in 2026. So this does not apply in 2025. Something to note, this applies in 2026, next year. Single filers will get a $1,000 deduction, and married filers will get a $2,000 deduction. And this is for non-itemizers. Usually charitable contributions are deductible on your itemized deductions. This allows taxpayers to take that deduction without itemizing, which can be beneficial. And I think will incentivize a lot of folks, general population, to make charitable contributions. I think it will be a great thing. And something important to note is that they have to be cash donations made to qualified 501c3 charities. So no property, no stock, and no donor advised fund contributions are allowed. So donor advised funds are something that we use a lot here at the firm. They're a way to contribute to charity. And a lot of times, more often than not, we're having clients bunch together years of deductions and contribute to a donor advised fund. And the initial contribution to the fund is a charitable deduction, and then the client subsequently writes checks or has our client service team initiate contributions to the charities. Although only the initial contribution to the fund itself is deductible, when it goes to the charity, it is not. So just cash donations, no clothes being donated to Salvation Army, no contributing stock, just the cash donations. Something to utilize if you are charitably inclined is this new deduction for non-itemizers. With the holiday season on the horizon, I think it's relevant to talk about gifting strategies. Specifically, bunching deductions into 1 year if you do not itemize, right? Things might look a little bit different with the new deduction for non-itemizers, but this is something that we have clients do relatively often. If a client is contributing $10,000 a year to charity, we might have them bunch together $50,000, 5 years worth of contributions into 1 year. That way they are able to take the deduction on their itemized deductions because they might not be getting a tax benefit for those deductions, those charitable contributions in a year where they're just doing 10,000. So bunching them together allows some folks to get that tax savings in a year when they might not have gotten it in the first place. Donating appreciated stock to save on capital gains and diversify out of a concentrated position. So this is something that we utilize a lot with our clients. We advise our clients to donate stock relatively often. Sometimes a client will have a concentrated stock position. Maybe they worked at Regeneron or GE, and they have a lot of their net worth tied up into one company. So we always advise clients to diversify out of those positions, especially if they're above 10 to 15% of their net worth in terms of how much they're holding within that position. So when you donate appreciated stock, you actually eliminate the gain that's built in to the stock or fund or mutual fund or ETF, and you receive the charitable deduction on your tax return. So it's kind of a double whammy. You save on the gain and you get the deduction. So it's really beneficial if you have an opportunity to utilize that strategy. It's great. Consider setting up a donor advised fund. So the donor advised fund was what I was just talking about. And when it comes to a donor advised fund, you could donate appreciated stock to the donor advised fund, and you get that full tax deduction. So instead of giving the appreciated stock directly to the charity, you put it right to the donor advised fund, and you get that same deduction and eliminate that taxable gain that you would be inclined to recognize on your tax return if you sold the position outright. And then utilizing qualified charitable distributions. So these are QCDs, and you have to be age 70 and a half to utilize a qualified charitable distribution. A QCD is basically when you're taking money directly out of your IRA and sending it to a charity. So at age 70 and a half, you're allowed to use it. RMD age is 73 right now. When it's really beneficial is when you're at RMD age and you're already charitably inclined. If you take out your RMD, you're able to take a portion. If you were already contributing to charity, utilizing a QCD is a great tool to reduce your taxable income, because if your RMD was 50,000 and you contribute 5,000 to charity, you could use the QCD and get your taxable income from 50 to 45,000. So it's really beneficial and definitely worth looking into along with all of these strategies. And then gifting on its own, aside from charitable contributions, folks love to gift their family funds, their daughters, their sons, their nieces, nephews. So when it comes to gifting, you can gift up to $19,000 in 2025 from one individual to another, and $19,000 in 2026 without having to file a gift tax return. So that's the common misconception that if you gift money, there will be tax due. That's not the case, especially for everyday folks. So how it works is there's a lifetime annual limit that your estate would be subject to. If you're above that limit, which is about $12 million per person, then you are subject to estate tax. So really wealthy folks, those that are worth, for a married couple, $24 million or more, are subject to estate tax. And the gifting annual exclusion of $19,000 comes into play, because if you gift over $19,000 from one individual to another, you're supposed to reduce that lifetime limit. So if I was to gift Scott $25,000, that's $6,000 above that annual exclusion limit. I would have to reduce my lifetime exclusion limit for my estate by $6,000. And that's why when you gift over that amount, you have to file a gift tax return, because the IRS wants you to track that lifetime limit. Because if you were to think about it, those wealthy folks would just gift money over the course of their life to get money out of their estate. This is a way that the IRS combats people doing that. The other thing to mention is to avoid gifting appreciated assets, right? Inheriting appreciated assets and getting gifted them are two separate things. If you inherit them, especially when it comes to stock or real estate or property, you get a step up in cost basis. So if I bought my house for $100,000 and when I pass away, it was worth $300,000, my son would receive a cost basis of $300,000, be able to sell the property and not pay any tax whatsoever. If I were to gift my son my house, he would inherit my cost basis. So that $100,000 would be his cost basis. If he sold the property, we'd have to recognize $200,000 in gains. So avoid gifting appreciated assets unless it makes sense from a tax perspective. So I'm going to let Scott move on and get into maximizing retirement contributions.
Thanks, Finney. So let's start taking a look at maximizing your retirement contributions this year. So for 2025, we see that the maximum you can contribute to an employer plan like a 401k, 403b, or a state deferred comp plan is $23,500. If you are 50 years or older by the end of the year, you can put an additional $7,500 into your plan as a catch-up contribution. Next year, 2026, the base amount for your employee contributions goes up to $24,500, or an increase of about $1,000, and the catch-up goes from $7,500 to $8,000. One thing to be aware of, which came into play this year, 2025, there is a new, what's called a mega catch-up contribution allowed for those that are age 60 to 63. If you are therefore 60, 61, 62, 63 years old before the end of the year, you can contribute up to $11,250 to your retirement plan as a catch-up contribution. The key thing to remember is it always looks at your age as of the end of the calendar year. So if you turn, 64 on December 31st, then you're, out of luck, can't do this additional mega catch-up contribution. For self-employed individuals, there are several different retirement plan options available for you, like a simple IRA, SEP IRA, or even a solo 401k. With most of these plans, you have until you file your tax returns to make a contributions, which would also include the extension deadline if applicable to you. This is different from employer plans, which are funded through payroll, and therefore you only have until the end of the calendar year to make things like your employee contributions and also those two various catch-up contributions. Additionally, it's also important to be aware of the total contribution limit for employer plans. This year, the limit is $70,000, and next year, 2026, it goes up to $72,000. And really, the main thing is it looks at the combination of your contributions as an employee, plus also what your employer kicks in as any sort of match or profit sharing as well. That's where the $70,000 or the $72,000 comes into play. In addition to these retirement accounts, your 401ks, there's also traditional IRAs and Roth IRAs to consider. These accounts are really great for anybody that is just starting off early in their career, or even if, you just started with a new employer and you're not quite eligible to participate in their plan yet. For 2025, you can contribute up to $7,000 into an IRA or a Roth IRA. If you are 50 or older, you can contribute an additional $1,000 or $8,000 total for the year. You have until April 15th of the following year to make a contribution to make a contribution for the current year. So you have until April 15th, 2026 to make a contribution for 2025. It's really important, though, with these two different types of accounts that you understand the eligibility rules, because it'll let you know whether you can make a contribution to a traditional IRA and take it as a deduction, or depending on your situation, you may not be able to. If you already have a employer plan offered to you, then your contribution may not be deductible. Similar, there are eligibility rules for making a Roth IRA contribution. It looks at your income. There is an income phase out and threshold where you no longer can contribute directly to your Roth IRA. Then really another account you want to consider contributing to is what's called an HSA, or health savings accounts. And I would say it's arguably one of the best accounts to have because of the triple tax advantage. That is, the contributions that you make to these accounts are tax deductible, the growth is tax deferred, and withdrawals for qualified medical expenses are tax free. There's really no account that allows, this triple tax advantage. One thing, though, to be aware of for these accounts is there are, again, with a lot of things with taxes, eligibility rules to make a contribution. Two of the key factors that you must be aware of are you have to be covered under a high deductible health plan in order to be able to contribute to one of these HSA accounts. Similar, you also can not be enrolled in Medicare. So even if you are covered under a high deductible health plan, but you're enrolled in Medicare, Part A even, then you cannot contribute to an HSA account. And you can see on the screen here what the various contribution limits are. For this year, for a individual coverage, you can contribute up to $4,300. Next year, that goes up to $4,400. For family coverage this year, it's $8,550, and next year that goes up by about $200 to $8,750. And another thing to note here is while there is an additional catch-up contribution that you can make to these HSAs, the difference here is you have to actually be age 55 and older to get the additional catch-up contributions, which is different than traditional IRAs, Roth IRAs, and 401ks because they have the age limitation of just having to be 50 plus, but HSAs are 55 plus. So with retirement plans, we can now switch over to talking about distribution planning. This transition can really be one of the most difficult times for people, individuals, couples, because you're used to earning this money, putting it away, but now you need to start spending down or living off of your portfolio. So here at Bouchey, we really focus on helping clients feel comfortable, having this smooth transition. And it's really important to understand the different types of accounts that you have. You need to understand what income streams you have. Maybe you've gone from working, for the last 30, 40 years, 9 to 5, and now you've decided to scale back and you have some part-time employment. Maybe you're one of the lucky people that still has a pension offered to you. You also may be receiving some sort of rental income from a property that you own. Social Security is, often something people ask us about, and it's all over in the headlines today. So it's really important to know what your various sources of income are and how they work. And really, not only how they work, but how are they taxed. So we'll now look at 3 different types of buckets that your accounts may fall into. The first one would be a brokerage account. These brokerage accounts are taxed on everything that is happening within the account as far as interest that is generated, dividends that are paid out, also capital gain distributions. While qualified dividends receive preferential tax treatment similar to capital gains rates, so they're either taxed at 0, 15, or 20%. Your ordinary dividends and interest get taxed at whatever your marginal tax bracket is, whether that's 0, 10, 12, 22, 24, 32, 35%. So it's really important to understand how the income is being taxed within your brokerage account. The next bucket that we look at is pre-retirement accounts. This would include things like your 401k, 403b, traditional IRAs, all of these get taxed as ordinary income when you take a distribution from the account. These accounts were funded with pre-tax dollars, so each dollar that comes out is going to be taxed. And under current law, that all of these accounts, once you hit 73 years old, you have to start taking a distribution each year, and it's based on the prior year-end balance and a factor which is determined by your age that year. So starts out at about 4% each year once you turn 73 years old. And the last bucket that we have is your Roth accounts. These accounts would be anything of a Roth IRA or Roth 401k, Roth 403b, and all of these are funded with after-tax dollars, and distributions are typically tax-free. Now we can really put it all together to understand what are some key tips and tools to be aware of, not only this year as we get ready to wrap up the year, but also looking forward to next year as well. First, you need to really make sure that you are paying in enough to avoid any penalties or interest because of having, under withholding on whether it's your pay stub or other retirement income that you're receiving. And the key here is to avoid a penalty, you must pay at least 90% of the current year tax or 100% of the prior year, whichever number is lower. And then there's one additional piece. If your adjusted gross income last year, if you earned over $150,000, you need to pay in at least 110% of the prior year tax. Again, a lot of numbers here, but this is something that we often look at and help our clients to make sure that they're avoiding any undue penalties and interest. Another thing to be aware of is that the first $20,000 that you take out of a retirement account is exempt from New York state taxes if you're 59 and a half or older. Also, New York state pensions are fully exempt from New York taxation. So if you work for New York State Teachers Union, or if you were a firefighter, these pensions are exempt from New York state taxation. Also, New York does not tax Social Security. There are a few states that do, but New York is not one of them. And we actually did a webinar last year where we compared what it's like retiring in New York versus other states. So it might be a good thing for anybody that's getting ready to retire to understand, what are the benefits and trade-offs, and that you can find that on our website. The next thing that we often look at is developing a distribution plan, that could have a combination of Roth conversions as part of it. They seem to be all over the headlines these days, so you definitely want to take a look at your exact situation to see if it makes sense. With doing Roth conversions, it could have an impact on your Medicare premiums. So you should be aware of where these break points are. And I do have, some of the break points for the current year on this slide. So you can see as the more modified adjusted gross income you have, the more that you'll pay in these IRMA, premiums for Medicare, depending on where you fall. And then finally, for tools and tips to be aware of, as part of the Secure Act, which passed a couple of years ago, there is a new provision that's coming into effect in 2026. It is that the catch-up contributions for certain employees must be made to a designated Roth account, meaning if you're doing a catch-up contribution and you're making over $145,000, your catch-up contribution has to go into a Roth 401k or a Roth 403b, whatever type of plan your employer offers. You no longer can have both your normal contributions and your catch-up contributions go in pre-tax. It has to go into this new Roth bucket starting next year. In the end, it really boils down to making sure that you're managing your tax brackets for efficiencies. While everyone's situation is a bit different, you really want to consider some of these. I've highlighted possible strategies. Because everybody's situation is so very different, it's important that you work with a tax professional like the team here at Boucher on these complex matters, because, one thing may impact another, as we talked about with, Roth conversions and your IRMA, and, what is the current tax bracket that you're in versus, the next 2 years or 5 years or 10 years, or you can really do sort of longer term legacy planning. What tax bracket are you in as opposed to your beneficiaries? Do you want to be the one to take the tax hit now, or do you, push up deductions or accelerate income? So these are all things that we would love to discuss with you and that we do on a regular basis with our clients. So as we wrap up this webinar, please keep in mind that there are several tax-related deadlines that are approaching. So make sure that you act now before it is too late. We have compiled a 2025 year-end financial planning checklist to help you stay on top of these deadlines, as well as many other considerations. This document actually will be going out to everybody along with today's presentation within 24 to 48 hours. We'll also be posting it on our website and our various social medias. Additionally, feel free to check out our blog and our prior webinars, which covers a wide range of financial topics that could be helpful not only to yourself, but maybe even a colleague or a family member, as you gather during these upcoming holiday times. And we just want to thank everybody for joining us today to discuss everybody's favorite topic, taxes. So let us know if you have any follow-up questions, and enjoy the rest of your day.